Stock started out this week on a sour note today, and it appears that the Nasdaq started to join the party a little bit. The Russell 2000 has been setting the tone, setting the pace to the downside, but it hasn't been joined by the Nasdaq and the S&P, mostly because of Apple. Right? Apple, as we talked about on Friday, has been kind of doing its own thing. Well, today Apple maybe has halted its advance and might be finally turning down, and you're seeing signs, more bearish signs in the Nasdaq starting to bleed into the S&P, and that might be a little bit, this selling that we've seen in small caps might start to be really broadening out now. So I'm going to show that and show what these patterns look like. And then we're going to take a look at one stock that's been a very good bullish stock breaking down on its own, a big NASDAQ 100 type name that we actually have had a previous market outlook trade on previously. We're gonna do a new trade on it today, so we'll talk about that in today's video. So let's go ahead and get started. Today is Monday, December the 13th, 2021. This is the market outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we came down today. We all know that we dropped about 1% on the S&P, but the intermediate line still is in bullish territory, still rising. So you still have dark green shading and a green line. Obviously, the short-term sentiment dropped. The momentum line dropped again to an extreme low point. That's, you typically don't hit extreme lows when you're bullish. I mean, occasionally, once in a blue moon, but we've been hitting nothing but. I mean, every low point has gotten down to an extreme on the momentum line. So not necessarily the best sign. The near-term line's already out of the reversal zone, but not into the bearish territory yet. So, technically, by definition, this is a intermediate confirmation signal. You have a bullish posture. It's not above 80. That's where it's a little bit stronger signal. But you have a bullish posture. You have an oversold momentum line. Now it's extremely oversold to the below the 5th percentile. But it's still, by definition, by the broad definition, a bullish posture with an oversold momentum line. That's to what degree is not part of the definition. That just increases the probabilities or odds of the signal. But a bullish posture on the green line, an oversold red line, that's an intermediate confirmation signal. So technically, you could look for a bounce here, and if we get a strong enough bounce, we might keep the near-term line from ever getting into bearish territory, which would mean this is still one big long near-term run. So keep that in mind in terms of the market forecast. In fact, you kind of would expect that. We're still above the 23rd percentile or 23rd retracement level here, 23% retracement level. Remember, we had dipped down below it, dipped below the 38. We started a bullish drop. We got dark pink shading and a red line for a single day. We got back above the 23% retracement level on that gap higher last Tuesday. We've held it since. So with that said, you would expect that we'd bounce off of this tomorrow, according to that chart. If you look at the Dow Jones Industrial Average, you can see a little different story. Like, we had just barely gotten above the 23% level on Friday, with Friday's closing a pretty strong close too. But then we got back below it today with a pretty strong, relatively strong engulfing pattern. Again, bullish intermediate confirmation signal, just not as strong of one. And the momentum near-term line came out of bullish territory, but did not drop into lower levels. So again, you would expect that you would drop, bounce, especially with the gap from last Tuesday holding. You would expect that we'd bounce off of this weakness that we had today. Here's your NASDAQ 100. Looks very similar. Intermediate posture is not strongly bullish. We actually did start to get into the gap from Tuesday on the NASDAQ. So a little bit of difference there. That's not, and the intermediate line is actually well below market sentiment. So and back below the 23% retracement level on that too. So a little bit of weakness there. And of course your Russell is getting by far the most weakness. Like it tried to get back above the 78. It failed. It's back below 100. We got a bearish close. We got a bearish posture. We got bearish short-term sentiment. That's we're back to dark pink shading and a red line on the on the Russell 2000. So this is bearish. We are almost 6% below the moving average. No matter what the S&P looks like, the Russell is on its own bearish posture, and so this is what while the S&P signal would tell you should expect a bounce tomorrow, the Dow and the Nasdaq kind of put a little bit of caution to that expectation, and then the Russell would say not even close, right? So the Russell would tell you that that this is what that chart's going to end up looking like, the S&P and the NASDAQ and all of that. So kind of keep that in mind. I think we'll probably stay more neutral with a very small range again. Like you see, we're below average on the Russell. So we'll probably stay with another below average range tomorrow, probably even more. Just a small, I would assume an inside day tomorrow, ahead of this Fed meeting, right? The Fed meeting that's coming out, because that's where everyone's going to be looking for the dot plots, the economic projections, the inflation concerns, the press conference. Are they going to start increasing the size of their tapering? Are they going to really start to signal rate hikes coming up soon? That's all on the table. And so I think probably tomorrow we'll probably get an inside day towards the lower end of today's range as we kind of wait and see how the market responds to generally what is widely expected from the Fed. But I think it's going to be like, okay, will the Fed actually do it? Because the Fed's been such accommodative mode. I don't think the market really believes that they will actually be in a restrictive mode. Even when they were kind of restrictive in 16, 17, 18, they really weren't. It didn't seem like they were. And so it's kind of interesting to see if they will actually have a little bit more to their a little bit more bite to their bark, so to speak. All right, let's take a look at the weekly chart here on this long-term chart, and you can see it's back. We got a bullish after getting a transition candle last week, bearish candle back to bullish. We got a bullish candle here, so very good sign from that perspective. The low point's at 46.25. We are at 46.69. So we'll see how we finish the week. So I mean that's a good sign. That's not the case for the Russell. We did get a little bit of an upper shadow, but we're back to a bearish candle on the Russell. We are not closing below the lows. It's kind of hard to get closes below the lows because you get such long lower shadows in the bearish moves. So I don't think you'll necessarily get that. The NASDAQ was also kind of transitioned to bearish. Very small positive differential. Your PPO is still falling. So not quite the bullish. We're not really getting bullish patterns there. Take a look at the 3 green arrow charts. You can see we got 3 green arrows on the SPY on diamonds, but you can see their MACDs are rolling over. The histograms are rolling over. The Qs actually have 2 red arrows now, so it's got clear shading here. And then you're almost back to. I mean, you're that close. I don't know. Like it looks like we're at point. The MACD, the histogram was at 0.00634. So 0.0064 if you round up. So I mean it was about as, we're pretty much close to 3 red arrows on the Russell 2000 again. If you take a look at the 2-line versions of these charts, you can see the S&P still above its 30-day moving average, though as you saw the MACD histogram is rolling over. So we'll see if this ends up being the peak for the MACD. Of course, we have to watch that 17-day, right? How do we trade relative to the 17-day moving average? The Qs broke below it, right? So the Qs, which has been our, your big leader here, they actually did, broke below these lows and the 17-day moving average. That you can see the MACD almost turning negative there too. And then finally, IWM is below its. It's well below 17-day. It's well below. It's broken back significantly below the 200-day, and well below the point of control again, and flirting with that 1-year value area. And of course, if you break below this happens to also be the 2-year value area. This 23% retracement. There's no support below you if the IWM breaks that level. Let's take a look at some of these other oscillating charts. The directional movement index, you can see both lines below 20, so very neutral for that. The ADX is back down below 20, same thing for the Qs. So essentially no bullish move anymore. IWM is a different story, right? We're almost back above 30. The positive's already, really low, but now you're bouncing back up on the negative. You still got a strong and rising ADX to the negative side, so very bearish pattern there. From an RSI standpoint, we failed at getting into bullish territory there, so we're kind of in this fake bullish territory when you're above 50 but not above 60, and we're rolling over. Same thing here. You're above 0 but we didn't get above 100, so kind of like it's this kind of fake bullish territory. The Russell 2000 didn't even do that, right? It got to 50 and it got to 0 and hit resistance and rolled over, And we're not quite, we are back below 40, but we're not back below 100 there. But you can see the strength of the bearish trend on IWM, right? It's gone back. It's almost back below -5. It's already back above 80. You're still below the cloud. You're back below that green line. About as bearish as you can be on this chart. SPY is still very noisy. You're above the cloud. You're above both the blue and the green line, but still very noisy. And we saw the Qs is kind of a little bit more bearish. You can see its green line is below its blue line, and so is the price now. And we've got the beginnings of a bearish trend, -1 above 50. Just very, very, very weak because we're still above the cloud, and you're not below that green line yet. But you can see it's a little bit more bearish than SPY is. Looking at the Bollinger Bands for SPY, we're in the upper half of the bandwidth still easily up there. Not the case for the Qs. The Qs are in the lower half, right? So a little bit more bearish. And then, of course, IWM's in the lower quartile again, or flirting with that lower quartile again. Flirting with that 1 year value, the bottom. Again, I don't expect tomorrow we'll get any follow through, right? I think any follow through we get this week will be after the FOMC. But I do think we'll probably get an inside day tomorrow where we'll trade inside the range here. Not so much in SPY, but more so on IWM. We'll kind of trade inside this little area right here, in my opinion. Take it for what it's worth. You got the low point from last week. That was last Monday. You got that low point from the previous week on Friday, right below that. And then, today's low point. So I think we'll probably use this point of control for a high tomorrow. These old lows for a low point, and we'll probably just stay here going into the FOMC. It would be my expectation. Of course, I could be wrong on that, right? Because that's obviously wildly, crystal ballish right there. SPY, you can see, is still actually holding that gap, but I mentioned to you the Qs are not. The Qs actually have started to break in. So there's the gap right where my cursor is, which essentially was yesterday's low. We have broken below that, and we actually closed below yesterday's low. So the Qs are starting to break into that gap. And that's a little bit of a sign that we might be more bearish coming out of the FOMC meeting than we are bullish. At least it appears the market might be prepping to be a little bit more bearish coming out of that FOMC meeting than more bullish. Obviously, that remains to be seen. The volatility index still is not pricing in a big move, right? We're still easily in bullish territory for risk, which is below 90% on this chart. So it's, we're at 20, but I mean we're pretty low. So the market's not too concerned, except when you look at the skew here. Let me look at the skew. It's going to be right here. Skew. I think I have it. There we go. The skew chart. You can see we are still near 150. Right, we're down to 146. It's still relatively high. It's below the average, but you can see the average is 148. So there still is a lot of concern, right? A lot of people are still hedging a tail risk event, right? A 2 standard deviation or more event. And obviously that would be a downside move because I don't think anybody's concerned about a 2 standard deviation move to the upside right now. All right, so just kind of summarize my technical outlook here. The expectation again remains that we'll be neutral tomorrow, probably really small range, relatively low volume. And then I expect that coming out of the FOMC meeting, when the Fed does probably announce a little bit more restrictive policies, I think we will fill in the rest of that gap on the S&P 500 and then continue on the bearish trend on the IWM. Like I said on Friday, I don't think, it looked like we started the new intermediate run there with that runaway gap. I don't think we actually did. I think this is still just a really big bounce, but I still think we're in the intermediate decline. And I think coming out of the FOMC will probably fulfill on that, like we have started to a small degree on the Qs, and like we already have on IWM. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that tell you why you're either a lot more bullish than I am or that you're a lot more bearish than I am? Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted there. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, that you liked the video today. And number two, that you want us to do another video again tomorrow. Quick way to give us feedback if you like our stuff. Of course, if you don't like our stuff, you don't have to click on anything. You don't even have to watch if you don't want to. Also, when you're down there, comment what stood out to you from today's video, or what did I say? What questions or comments do you have about what I said? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle, @DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, check out some of these other things over here on the right. Click on this image here, this Market Outlook live image. It takes you to this page. It takes you actually to, let's actually take you there. Over here. It takes you to this page. This is where we do the Market Outlook live at 3:30 Eastern Time on Monday, Wednesday, and Fridays. I review all the old trades. We actually closed 2 trades today from prior Market Outlook videos, so including today's that you'll hear later in the video. Today's trade idea as part of that. And we also did put on today's trade already before the market closed. We do that during this video as well. Again, you get to there by clicking on that image, or you can come over here in the mouse over Market Outlook, click on Live Trade Review. If you scroll down, you can see our upcoming classes here. Click on this View More. That takes you to your calendar. Here's all of our upcoming classes, as well as our recordings for all of our prior classes, up to 3 years worth of recordings. You can get to there. You can also get to it by clicking on Trading Rooms or Class Archives right there. If you come down here, click on this heart. It opens up this new tab. Hit that like button. Also click on this thumbs up icon. It opens up this tab. Come down here and click on that like button. Again, the more you do that, it helps get our content out to more of our followers because of how these social media algorithms work. So that's why we always ask you to do that. But it also benefits you too because Twitter and Facebook promote content in your timelines from the accounts that you engage with. So we try to make it really easy for you to engage with us here so that you can keep getting our stuff when we post it. All right, now let's take a look at what's driving the price action. You can see from this chart, this is a 3-month chart, that risk really had a bad day outside of commodities because it's really a big inflationary. The story is inflation right now, and hard assets do well. Real estate and commodities do relatively well relative to paper assets like equities and bonds generally. But bonds did outperform commodities here, just not real estate. And there's treasuries up there at the top. And really risk off day: gold, dollar, global bonds, corporate bonds. And then international stocks got hammered. The dollar was up, and they put a lot of pressure down 2.5–3% on EEM. Just big declines in international equities, small cap stocks, the Qs both dropping, underperforming SPY, which is rare again because remember the Qs typically are a safety trade themselves. So for them to be just as bearish as IWM on a down day for risk as a whole, it's kind of an interesting pattern there. Let's take a look at TLT. You can see we had dropped. We got down to light pink shading yellow line last week. We have since bounced up, right? And short-term sentiment's trying to rally. Intermediate line has come down to this market sentiment line. It's slowing, so we'll see if we end up holding. You can see we've closed above the high of the low day, right? This would be the low day, so we obviously closed above that day's high and started to fill in that gap there. So that's a good sign for gold. You can see a GLD is basing, at least trying to base. Let's take a look at this chart here. Look at TLT holding its point of control, getting back above its 8-day moving average. You know, you got price 8, 17, 30, 50, 200. And they're all rising. So it's it's a good sign. I mean, that's the right order if you're trending, and in this case, trending to the upside. Gold is building a base. It's building a big point of control here on the 1-year chart, and you can see even on the 2-year chart, that's still a point of control right around that 200-day moving average. So you got a lot of lines, a lot of moving average sitting here. So it's really kind of basing and setting up for some kind of move, right? And then you look at like the US dollar index. And you can see, it's been trending higher. It got back above its 8-day moving average today. You got price 8, 17, 30, 50, 200 all rising in the right order. So the opposite would be true of the euro US dollar. Though the euro wasn't down as much, the euro is kind of in this bearish convergence, right? The MACD is above its moving average. So if it's bullish for, if you're rising on the euro, that means you're falling on the dollar. So you're bullish on the euro, but you're not really that bullish, right? The MACD is green, but you're converging, right? The MACD is above its moving average, but it's not above zero, and it doesn't look like it's going to get above zero because we've been holding the 17-day moving average and now potentially rolling over. So the euro might be actually making a bigger decline to the downside. Let's take a look at the currencies and how. One more chart I want to look at is Bitcoin, again as a reflection of risk appetite for our speculation, right? Not for hedging, not for inflation hedging, but for speculation. You can see the breakdown that we had today, breaking down below the lows of the last week. Well, more below the 200-day moving average than we've been. Now you've got the 30-day crossing below the 50 and the point of control up there. You're breaking below the 38% retracement level of this big run that we've had. So things are not looking good for Bitcoin. And the other speculation proxy would be ARK investments, and you can see it remains very bearish, and now we have a new leg to the downside with very little volume support below you here. So things can get really bad very quickly for ARK. Again, using it as a proxy for high speculation trading, there's just you're in a very bearish trend, and there's very little support below because you moved up so fast over there. You've got Fibonacci support at 81, then you got your next layer of Fibonacci support at 60, which happens to be the pre-COVID highs. So those two things are kind of like your, here's Bitcoin. Those are your speculation proxies, and you can see Bitcoin's on this bearish divergence trade right now with very little support below it too on a volume basis. Even if you just, I know it's 5 years, even if you just look at the last two, very little support until you get further down into this area. So things are not looking good for the high risk trade, right? For the really risk on move. And again, we talked about emerging markets being part of that and commodities, but emerging markets especially, and you can see the bearish trend that they're in. They're in the death cross environment. They're making a new leg lower in this. We failed at the 200-day moving average. You could almost argue that emerging markets are in a bear market. Bear market again. Again, the last time we had a bear market for these was again extended death cross environment where we failed at the 200-day moving average. You could argue started in 2018 and we went pretty much all the way through the COVID low point. So it appears that we're headed in that direction again with the 30-day falling back below the 50 and making a new leg to the downside here, trending for emerging markets. Again, not a good sign for risk appetite as a whole. Let's take a look at let's look at the 12 grid for those major economies to see what they look like. Because remember, developed markets didn't look too hot either. And there you go. Look at Japan dropping down, China dropping down, the UK really dropping, France really dropping hard. Russia is dropping down, Canada is dropping, Brazil reversed its move to the upside, Korea dropping hard, and they had been more bullish. Italy dropping down hard. Germany's actually held up the best. So it's all a big reversal right now. Very different picture in all these other major economies compared to the US. So we're broadly risk off right now, and really it's, we've talked about before, the one stock that's just continuing to keep the S&P as a whole afloat is Apple, and Apple got a pretty bearish candlestick pattern. That's not an engulfing pattern, but that's a dark cloud cover where you gap up and then you have a good bullish candle, and then on the next candle you gap up above it, and then you fill in the gap and you pretty much reverse that big bearish bullish candle that you had on the previous day. And with a lot of volume today, because they were trying to get to that $3 trillion mark. We came about 70 cents short roughly per share of actually hitting that $3 trillion mark. So we may have in essence hit that target. The reversal pattern would tell you that we are bearish in the short term. So obviously you're very overbought. You're in this parabolic move to the upside. I think I showed you on Friday all the charts So we got this big divergence on the CCI. We're very parabolic here, and if Apple starts to falter down, then look for the Qs, and by default then the S&P to start following the direction that we see small caps and other risk asset classes going already. All right, so for our trade idea today, I want to take a look at NVIDIA. NVIDIA has actually been a stock that we've been trading. We actually did a bear call spread on this previously, and in our Market Outlook Live video today, we closed it. We hit 50% of max gain already, and on bear call spreads, when we hit 50% of max gain early, we just take it because it can be very volatile. You can do another trade if you like, and we actually did. So we did another trade on NVIDIA. We're going to look at a long, because now things are looking a little bit more directionally bearish here. You can see the intermediate line's falling below market sentiment. Short-term sentiment's gotten very bearish. The intermediate line looks like it's about to fall out of bullish territory there. We're well below the moving average, about 7%, almost 8% below the 30-day moving average. When you look at that long-term chart, NVIDIA, you can see we hit this kind of transition candle a couple weeks ago. It turned bearish, but still kind of transitionary. But now we got a bearish candle here with a red arrow, falling PPO that's still at a very high level, and a negative differential. So that's your signs there for an intermediate decline. When you look at the 3 green arrows here, you obviously have 3 red arrows, which can be a buy signal, but not when you're that far below the moving average. That tends to be more bearish. You can see that when you look at the 2-line version of those charts, well below the 30-day moving average. See the gap in volume. See, last time we tried that, we bounced hard off the low. This time, not so much. We finished at the low. So pretty bearish divergence going on now. We had this bullish convergence going, but now we are in bearish divergence mode, and stochastics is dropping now below 40, and the moving average, the forward stochastics, looks like it's also dropping below 40. You can see the RSI and the CCI dropping below 50 and below 0, and into negative territory, almost below, well below 150 on the CCI, but almost below 40 on the RSI. Look at the directional movement index, and you can see we got a bearish crossover, but with the ADX already above 30, which means we had a good bullish trend going, but usually that transitions to a pretty good bearish trend. At least it can when your ADX is still this high and you get that crossover. When you look at the Ichimoku trend cloud, we are below well below the blue line and well below the green, still above the cloud, but now you no longer have the strong bullish move, right? We hit 0 on both those lines. So the bullish trend is done. The red line is going to be well below, unless you make a big jump tomorrow, that red line is going to be well below the price there. So it is today even. So we are actually lower today than we were 26 days ago. So that's a pretty bearish move. When you look at like the kind of the short-term chart here, or the ATR, you can see that the ATR is really spiking up. Big run up on the ATR. It's making a big move with a lot of volume here. When you look at the intraday is what I'm going to look at. You can see we've gone bearish here, like we've almost hit a new low point, and pretty much have, but we're right on that new low point. So we had this bearish Arun. Let's see here, right over here. We had this bearish Arun signal a few days ago, but remember we came off the low. Now not the case. So probably we'll get a bearish Arun signal tomorrow with that bullish move really falling down. You look at the Bollinger bandwidth and the Keltner channels. You can see the bandwidth is actually as wide as the Keltner channels are. As wide as the bandwidth is, it's actually still inside the Keltner channels. So and we're just starting a negative momentum move down here. There we go. Yeah, it's just starting a negative momentum move. So we are kind of on the cusp potentially of a significant breakout, in this case to the downside on NVIDIA. And when you look at the fact that there's just not very much volume here, we could come down to 225 pretty easily without breaking a sweat, because we moved up so fast here that we didn't get a lot of volume in this area, and now we're breaking through. And so it's easy to fill in. As fast as easy it is to go up, when you go up with little volume, it's just as easy to go down when there's little volume there. So that appears to be the case. And so what we decided to do, and not just to buy back not just to buy back the call spread, but the 50% max gain, but we came down, we sold the 245, bought the 250 put spread. So for about a $500 risk, we're going to shooting for about a 4-to-1 reward to risk ratio if it works out. Of course, if it bounces back up sharply, we can lose a few $100 and try to get out early. But if not, then we got a really good return for a worst case scenario of about half my normal risk. About 4 times the reward if it gets down below 245 and of course and stays down below 245 by January expiration. Alright, well that wraps us up for today. You've heard from me, now I want to hear from you. Use that link that's popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's threads, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel as well as our website at marketscholars.com. Click that thumbs up icon, like us on Twitter and Facebook as well, comment on the video. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.